Well, good afternoon and welcome everyone to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and how all of this impacts our decisions on the best courses of action for your portfolios. Thank you for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it is more convenient. I am Scott Tomlinson and I'm joined by my partner and colleague Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson. We will have our Q&A period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to join in, ask questions. HighRock was founded by Paul in 2010 to manage a series of closed-end funds for the Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we're off to a great start. We've added a number of new families over the past few weeks, and we're talking to many more that are thrilled with the direction that we're taking. Our private client division was established to take advantage of some of the synergies that come with the $200 million across 4 funds we manage for Scotiabank. Important to understand, we are not brokers, investment advisors, or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Most financial or investment advisors are not paid to manage money. They are paid to gather assets and find a mutual fund or other third-party manager to place your money with. In fact, many advisors place their clients' money with HighRock. This means that they are paying fees on top of fees. In essence, our private client group is intended to take out the middleman and save our clients money. Now, we have our money invested in the exact same way as all of our clients. So whatever we do for all of our portfolios. And in essence, we all here at HighRock have our skin in the game. Our fees are simple and transparent, and to us, that is very important, the whole idea of full disclosure and well beyond the regulatory requirement. Okay, last week we initiated a discussion about how we analyze risk for the purpose of portfolio management, trying to find the most efficient way to maximize return while at the same time minimizing risk. And to do that, we identify risk, we assess that risk, we try to find the best solutions to mitigate it, and by virtue of that, establish controls, and of course we monitor to make sure that all of the risk that we are taking is within the framework of everything that we're trying to accomplish. And what are we trying to accomplish? Well, what we try to do is find what we would call the optimal place to be for investing, and ultimately that means that we want to find how we can take the least amount of risk but get the best possible returns. And when we talk about the risks relative to the markets, we look at the potential of a pure equity portfolio represented here by the S&P 500 or the S&P TSX indices, and you can see that the fixed income 60% equity, 40% fixed income model can significantly reduce risk and still achieve an annualized return of between 7 and 8% over a multiple year period. This is why we know that balance is important to reducing risk. So let's check in on our broad economic themes for 2015 and assess the risk of some of the latest developments. One of those, and it's coincidental that the U.S. Federal Reserve, the Federal Open Market Committee, is meeting as we speak. We're expecting an announcement tomorrow. So the current thought in the market is that we will see a September increase of 0.25%. But let's see how that impacts how we look at the risk factors. So one of those risk factors that we pointed out last week was interest rate risk. Are interest rates going up or down? Well, we expect that at some point, either towards the end of this year, in September, as most market participants think, or perhaps in early 2016, the U.S. Federal Reserve will start to raise interest rates in small quarterly point moves. However, in order for us to try to understand the risks that this imposes on us and our portfolios, we thought we'd have a look at what happened the last time the U.S. Federal Reserve started raising rates, and then that was back in 2004 when the U.S. economy began to exhibit inflationary pressures. So if markets are expecting interest rate increases from the Federal Reserve, the initial reaction is for bond investors to sell bonds, which drives bond prices lower and bond yields higher. However, if the Federal Reserve's interest rate increases have the desired impact of reducing inflation expectations in the market, after time, the bond market adjusts. I'll get to that just in a little more detail in a second. In Canada, similar story. Back in 2004, the Bank of Canada started to raise interest rates. It wasn't quite as dramatic as the U.S. Rate increases, but still the same time frame. They raised until 2006. So that brings another kind of risk into play, and that's watching what impact the interest rate moves might have on our decisions on what the duration of the bond portfolio should be. What term to maturity, on average, should we have a portfolio at during times of higher or rising interest rates? So we call that duration risk. And again, this is something that we pointed out last week, but we're looking at this in a little bit more depth. So if interest rates move higher in the future, how might that impact our decisions? Well, let's look back at the U.S. situation through the period of 2004 to 2006. As the Federal Reserve pushed short-term interest rates higher, the greatest impact was on short-term maturities. So it makes sense to have a bond portfolio that was exposed to longer maturities, 10 years or longer, where the impact was minimal. Now this, as I said, all has to do with expected inflation. Bond investors will expect that the Fed will control inflation with higher short-term rates. Therefore, they do not demand a higher premium farther out the yield curve to protect them from future inflation because they think that it will remain contained. And that's why we see that yield curve actually going from a positive slope to a flat slope over that period of time. But as you can see quite clearly, you want to have a longer term duration for a bond portfolio at during this time frame. In Canada, a similar situation, again, a little bit different at the same time. When the bank rate was being raised through 2004 to 2006, it certainly impacted the short-term interest rates so that the yield curve, again, flattened. But interestingly, out in the 10-year area, bond investors were even less concerned about inflation, obviously, because they started actually to push bond prices higher and bond yields lower. So in Canada, back at that point in time, it made sense to be, again, have longer duration because it was actually a positive impact on a bond portfolio. So the farther out the yield curve you went, the better it was for a bond portfolio because as yields came down, prices were going up. So our assessment of interest rate risk and duration risk is then a function of inflation expectations. We have to be on a heightened inflation watch, especially if we think that the central banks are being distracted by other issues. And what might some of those other issues be? Well, let's go and talk about what the expectations are for the U.S. economy. The general expectation is that a very strong U.S. economy in the second half of 2015 will be pulling the global economy higher. And we saw that and have seen that certainly from the Bank of Canada, anticipating that in the second half, a stronger U.S. economy will be of assistance to the Canadian economy. So that's one of those expectations that's out there. But certainly some of the economic data that we're seeing doesn't necessarily point in that direction. So the U.S. consumer is about 2/3 of the U.S. economy, so we watch very closely to what the U.S. consumer is doing. And last week, the U.S. retail sales data showed a bounce in the month of May. However, it's really not enough to turn the trend that we've seen basically since 2010. And that theme is that, and something that Paul and I have been watching very closely is that there's a structural shift happening in the mentality of the consumer. As baby boomers age, they're more focused on saving for retirement and less on spending. And the new cohort, the millennials, that are basically taking over as a greater percentage of the population, they're being driven by different consuming and saving priorities. So we definitely have been seeing a trend to lower retail sales, and that's something that obviously we have to monitor closely and watch if that trend and see how that trend develops and continues. Another bit of data released last week, earlier this week, in fact yesterday, showed that manufacturing in the U.S. continued to slow, with industrial production actually declining. Even though they're expecting a positive number, it actually declined by 0.2%. Now, industrial activity in the U.S. represents 20% of the economy, so we're seeing some significant activity there that's showing that the economy continues to slow. So with the consumer saving more and industrial activity slowing, it's becoming more difficult to see the U.S. economy growing as strong as it may have been expected to do so in the second half of 2015. So it's also something that we really do have to monitor closely. And of course, when the Federal Reserve is meeting, I'm sure they're going to be thinking and discussing the same kind of data. And it may, in fact, be something that might give them some apprehension about raising interest rates in September. Well, as we said, we're always monitoring the inflation or deflation situation, and something that we also want to be monitoring is the global situation. And of course, we've been watching very closely the situation in Europe. The deflation scare appears to be ending. The most recent data showing that inflation is actually bouncing back, and that clearly says that the policies, the monetary policies of the European Central Bank and President Mario Draghi have been successful thus far with their aggressive quantitative easing and bond buying policy, in which they embarked upon in January. So that leads us to trying to determine, where bond markets go from here. Well, certainly in Germany, we've been watching some volatility. Bond investors have pushed German yields up from close to 0% to slightly above 1% in less than a month before it settled a little as we've seen a bit of a flight to quality in light of what's going on with the standoff between Greek and its creditors. So that flight to quality has impacted where investors are moving away from riskier bonds out of the countries of Greece, of course, but also Italy, Spain, and Portugal in favor of safer German, U.S. and Canadian bonds. So it's actually brought a little bit of buying back into that market, and the volatility is subsiding ever so slightly. But it has been a very volatile time. And something that we always talk about is that we know that bond markets lead other financial markets. So how do we perceive that volatility is impacting the markets, and that brings up that whole idea that we talked about again last week a little bit of another risk factor, and that's market risk. So it's something, of course, that we have to assess and attempt to mitigate as best as we possibly can. So in so doing, we watch volatility creeping above its its recent averages, and that's a function, of course, as I said, bond market volatility creeping into equity markets. And so, but our market assessment has been that we have anticipated this, and we've anticipated this kind of risk. So, of course, we position client portfolios accordingly. I'll talk about the client portfolios in a bit, but let's talk about what's going on in equity markets a little bit, because we've been seeing this correction that's been happening on a global scale, except in Japan and perhaps China, in equity markets. So let's focus on the S&P 500 here a little bit, because we have seen some short-term downtrend develop, and this correction now at about 3%, or at its most recent lows. We have seen a little bit of buying support coming in earlier or late last week, and again today. So we may, if that buying support holds, we may go back and test that downtrend line to see if we get more selling. However, if buying support doesn't hold, we could see a test of lower buying support levels and a continuation of the correction. We look for the correction to move beyond that 4.5%, perhaps even to the 8% level. So that's where we think that it makes sense to start putting new money to work, and it's something that Paul and I discuss on a regular basis, on a daily basis for that matter, and we continue to analyze all of the data to make sure that if something should change, if this correction should run its course sooner rather than later, then we want to be prepared for that as well. On the other hand, we also want to watch and monitor the momentum on the downside. If downside momentum picks up, if more selling comes in because fewer buyers are there to support the market, then we also want to be aware of that, and then certainly we want to monitor the risk that presents for our client portfolio. So for the time being, of course, as I've talked about before, we're being cautious. And that leads us again, as you may assume, to talking a little bit about portfolio risk and how we're positioning our portfolio models. Let's start with talking about our fixed income. We have given the bond market volatility, talked about what we think might represent buying opportunities. So a few weeks back, we took advantage of the weakness, added a small amount of 10-year Government of Canada bonds. We've really not added any since, looking and watching mostly for a little bit more of this volatility. We've seen a bit of that volatility subside, but we want to get a little bit more evidence of that before we stick our toes back in the water. Certainly, the announcement of the policy stance by the Federal Reserve tomorrow at 2. We'll be monitoring that very closely to seeing if it sheds any further light on what their thought process is towards when they may decide to start to raise interest rates. So again, caution until we just have a better read on what we think is coming next. Not much change in our global equity model. We're still monitoring European markets. There's been a greater correction there. In the UK, the correction got to about 6%, and so we want to keep our eye on what's happening there. In Germany, the correction's been about 11%. Again, broken below the uptrend, so we want to just be cautious and monitor what's happening there before we actually take on any further buying. But if that develops any further downside momentum, it will be a function probably of other equity markets taking the same path. North America, we talked about the U.S., but in Canada, the correction continues there as well, now down to a correction of about 5% from its recent highs. So again, caution still part of the mantra here at High Rock. In Japan, though, bit of a different story. Even though markets have come off their highs, not significantly so. So the uptrend is intact, and we're just not interested in putting money to work here at this particular point in time. And then emerging markets is another place where we would normally have about 5% of our clients' money. Outside of China, because China is a bit of an anomaly here, but outside of China, we're still seeing some downward pressure. So again, monitoring that closely, but really not yet comfortable to undertake any particular strategy of adding at this juncture. The Canadian growth equity model, I'm going to actually call Paul in here to give us an update from his perspective. Paul pretty much focuses on the Canadian small and mid-sized companies that we look for opportunities in, and I'll just let him throw in his bit here.
Thanks, Scott. Story's the same, obviously, as we have on the screen, still looking for value. A few of our names that are sort of our favorite go-to names have run up a fair bit, and we just can't bring ourselves to buy them at these prices. We think they're a little overvalued. We have initiated a couple very small positions to dip our toes in the water and a couple value plays that we like. But again, we're being even very cautious with those three situations that we have, and that is on top of the Air Canada position, which we are now flat in. That trade worked out pretty well for us, so that's it.
All right, thanks, Paul. And one last, more administrative situation. We want everybody to go and check into our website and check out the High Rock Challenge survey that we've posted there, and also to feel free to send it to your friends if they'd like to get involved. We're trying to do a little market research for ourselves, and this is something that we hope will help us as we turn our directions and the directions that our clients think are important. There is a very serious prize involved, so make sure to get to it. All right, well, that is it for today's discussion. But if anyone who is listening on the call has a question, please feel free to ask it now. Doesn't appear that we have any questions, Paul. So if you do have questions, though, if you're listening to this as a recorded version, please always feel free to email us, give us a phone call. We are here 24/7 to take your calls and emails, so please don't ever hesitate to get in touch. But that's it for another week. So once again, thanks for taking the time to tune in. Have a wonderful week for the remainder, and we'll look forward to chatting with you next Tuesday. All the best.